markets flipped from panic to melt up after Hormuz reopened to commercial shipping, sending oil sharply lower and stocks to fresh highs. But the week did not end there. The IMF cut its global growth outlook, warning of stagflation risk, while China's latest data showed strong factories, weak consumers, and a property sector still under pressure. Welcome back to the weekly market recap. Let us start with the move that changed the whole tone of the week. On April 17th, markets flipped into relief mode after Iran said the Strait of Hormuz was open to commercial shipping during the ceasefire period, and President Donald Trump said he expected a broader deal to end the war soon. That mattered because Hormuz is one of the world's most important oil choke points. For weeks, investors had been pricing the risk of a prolonged supply disruption, higher fuel costs, hotter inflation, and tighter financial conditions. The moment that risk looked smaller, the whole market reaction changed. Oil plunged, bonds rallied, and stocks surged. What had been a war premium suddenly started to unwind across commodities, rates, and equities. The clearest sign of that relief was in crude. Brent fell roughly 9% and dropped back below $90 a barrel after having traded as high as about $119 during the earlier phase of the conflict. West Texas Intermediate also tumbled around 9% and slid into the low 80s, erasing a large part of the war premium. European natural gas prices moved lower too. With energy pressure easing, U.S. Treasuries rallied as investors pulled back from near-term inflation fears, and the dollar softened against some major peers as risk appetite improved. In equities, airlines, travel names, and transports outperformed, while energy shares lagged. The message was simple. Lower oil meant lower expected fuel costs and less pressure on central banks to stay restrictive. The equity response showed this was much bigger than an energy trade. Wall Street pushed to fresh records, with the S&P 500 closing above 7,100 for the first time, and the Nasdaq also ending at a new all-time high. Volatility eased as investors embraced a classic risk-on move instead of a defensive scramble. This mattered because the market was not just celebrating cheaper oil. It was repricing recession risk, inflation risk, and the expected path for policy all at once. Still, this was a relief move, not a full return to the old world. Even after the drop, crude remained well above pre-war levels, so investors did not treat the danger as fully gone. But the late-week reversal set the closing mood as decisively risk-on after days of war premium and supply shock anxiety, and that left markets heading into the next story with a crucial question: would weaker energy stress be enough to offset a darker global growth outlook? After the Hormuz relief rally, investors got a colder reality check. On April 14th, the International Monetary Fund cut its 2026 global growth forecast to 3.1% from 3.3% in January, while leaving 2027 at 3.2%. That made the message clear: the war shock had now entered the official global baseline. The fund also warned that headline inflation would rise modestly in 2026 before easing again in 2027. In plain English, that is a stagflation risk, meaning slower growth paired with more price pressure. The release landed during the spring meetings in Washington, giving markets a formal framework for thinking about the week's geopolitical shock. The IMF did not describe this as just an oil story. It tied the downgrade directly to the war in the Middle East, higher commodity prices, firmer inflation expectations, and tighter financial conditions. It also said the damage would likely hit emerging market and developing economies harder, especially commodity importers with weaker buffers. The baseline assumed the conflict stays limited in time and scope, which is important because even the central case already includes economic harm. And if the conflict lasts longer or spreads further, the fund warned that global growth could weaken more and markets could become more unstable. There was another layer to the warning, and bond investors paid attention. The IMF said a typical defense spending boom can lift activity in the short run, but worsen the medium-term fiscal picture. In its example, defense outlays rise about 2.7 percentage points of GDP over roughly 2.5 years. Fiscal deficits worsen about 2.6 points, and public debt rises about 7 points within 3 years. That matters because bigger deficits and more debt supply can keep pressure on bond yields. So even as stocks pushed higher late in the week, the IMF reminded investors that the backdrop was still fragile. The takeaway was simple: less immediate energy panic did not erase weaker growth, stickier inflation, or policy uncertainty. And that set up the next big question for markets: whether China's latest data would ease those growth fears or deepen them. After the IMF downgrade, China gave markets a more complicated signal. On April 16th and 17th, the country released its biggest data dump of the week, and the headline looked solid. First quarter GDP came in at 5.0% year over year, up from 4.5% in the fourth quarter of 2025. Quarter-on-quarter growth was 1.3% after a revised 1.2%. That told investors the world's second-largest economy was still holding up better than many feared. But underneath that headline, the split was obvious. Industrial production rose 6.1% in the first quarter, with equipment manufacturing up 8.9% and high-tech manufacturing up 12.5%. March industrial output also rose 5.7% from a year earlier. Retail sales were much weaker. They rose just 2.4% in the quarter and only 1.7% in March. So the supply side was improving faster than the consumer side, which is why investors treated the release as resilient but incomplete. The property market was still the clearest drag. First quarter fixed asset investment rose 1.7%, helped by infrastructure investment at 8.9% and manufacturing investment at 4.1%. But real estate development investment fell 11.2%. Floor space sold dropped 10.4%, and sales value fell 16.7%. That is why the data did not remove the case for more policy support. There were other signs of stabilization. First quarter CPI rose 0.9% from a year earlier, up from 0.5% in the prior quarter, and March producer prices turned positive at 0.5% after a 0.9% drop in February. Trade was stronger too. But the final message was still mixed. China looked resilient enough to steady global growth, not strong enough to declare a full domestic rebound.